Go.
Streaming from South Africa to the world. This is the Stonks Go Moon podcast. What just happened? We break it down so you don't have to.
Welcome everyone to the Stonks Go Moon podcast. My guest today, Adrian Alberts. He is a futures and options trader, founder of the Black Heart Red Spade podcast, and as well as a public speaker. I struggle to fit in everything there. Adrian, thank you so much for joining me. I'm absolutely stoked to have you.
Thank you.
What an opportune timing. Sometimes things just work out. We were supposed to record yesterday, and then the CPI figures came out, and the market absolutely lost its fucking mind. Ripped higher. I was going to.
Not even a word.
It's not even a. Because if we spoke about this yesterday, this whole podcast would have been null and void by next week. It would have been, well, that was so wrong. So let's talk about the state of the market, right? It's not like 8.5 CPI is better. That's what we saw in March. Why are we celebrating about 8.5?
Did you ever watch a movie back in the day called Little Nicky with Adam Sandler?
I love it. Yeah.
Do you remember the character called Nipples? So I'm going to use the market I'm going to use this as an analogy. There was my namesake, who was the devil's brother, actually said, soon you will experience a fate more horrible than he stops. And he's like, well, maybe not that horrible, but still pretty bad. Well, that is the CPI figure at 8.5. I mean, let's face it, it's not good. It really isn't good. And anyone who says that 8.5 is a victory for the market, you need to get your head read by any measure. The market is almost like, and gosh, I'm going to get into trouble for saying this, but it's almost like a drug addict in a way that is chasing a high. It's like, yes, here's my next fix. Here's my next fix. And yes, we can make a lot of money from it by getting on the right side, but it's so easy to get trapped if you're on the wrong side too. And quite honestly, nothing makes sense to me anymore. It's like fundamentals just don't matter the same way that they used to.
No, well, the macro doesn't make sense, and that's where I was pretty vocal the last couple of weeks about the market, and the technicals and the macro isn't speaking to each other. There's a divergence, right? So the bounce, the technicals to me, even if you're using something simple like a Laguar or something like shows you, hey, there's an uptrend coming. Everything, or the technicals to me at least, didn't suggest a bottom, but there is some upside, change of momentum, things are changing, right? So whenever that happens and we get to a crossroads, like I said yesterday, it becomes a 50-50, and a 50-50 is gambling. That's that high that you like, and whenever it gets to 50-50, I get out, because then I can't tell you, it's like with a high degree of conviction, hey, this is gonna happen. If I don't have conviction, then we are gambling, right? And I feel for the people who were short and they kept that bias about, hey, everything is fucked. The economy is fucked. Inflation, QT is still happening. And now those positions are seriously underwater.
Oh, yeah. So they are right, so they are right from the macro perspective, but wrong from an actual trading perspective. And I think markets just show us time and again that they really don't care what we think or what we feel. It's your opinion. And I even said that this morning to Aisha when I spoke with her briefly on Twitter, that I know my opinion doesn't matter, but it still feels crazy that we are here, given all the storms that are currently waging and the ones that are forming on the horizon. Nothing has really changed. I mean, quite honestly, what has changed, Rocco? Please enlighten me.
Absolute nothing. And that's why I said nothing makes sense fundamentally and on a macro level, and all that I have is my technicals to say, oh, you call it what you will, you can call it It's not well, fortune telling or astrology or whatever, or tarot card reading. That's the only thing where I saw, hey, there's something going on and the winds are changing. So whatever it may be, it is what it is. Doesn't make sense.
All hindsight.
It's
But isn't it
hindsight.
all hindsight too? I mean, that CPI figure could have been 8.8, for example. And can you imagine how the market would have dropped then?
So it's 50. So that's why I said when it becomes a 50-50, it's like, it sounds so stupid to say, oh, the market can either go up or down. It's like, duh. Yeah, you know what a duh. But that's what a 50-50 is. If you don't know, then you don't know, because it could have gone either way, but then you're not trading, you're gambling.
But I'm glad you brought up that point, because that is such a key thing for anyone who's new to trading or maybe even experienced in trading to get, is that the only thing that is 50-50 is your outcomes. Your setup is not necessarily, if you go for a 50-50 setup, then you are, as you said, literally gambling. But the one thing that you cannot control is your outcome.
Yes.
You know, and that is always 50-50, 100%.
Thank you so much
for
thank you so much for providing me with my segue, and that's was one of the key things I wanted to talk to you about today. And so the reason for this podcast is I'm not an options trader, and there are a lot of people, especially in America, because of the way that their derivatives are structured, that more on the option side that we are than we are in emerging markets. But I know you've spent time in the UK, you've spent time in other places, you've had other exposures, and there's a lot of interest growing in options. So if like imagine I'm like a 4 or 5 year old smart toddler level, like I always tell Simon Reed, like explain to me like I'm a smart toddler, you know, like, and I come to you and say, Adrian, what is options trading? How does it work? Let's unpack that a bit so people can sort of get an understanding of what it is.
Well, first, before I tell you what they are, let me tell you what they are not.
Okay.
You know, let's use a via negativa approach. So for those who are not familiar with via negativa, it's a phrase that I learned of when I was reading a book called Anti-Fragile. Actually, it was Black Swan by Nassim Taleb. And via negativa essentially means that it's easier to figure out what you are by first figuring out what you are not.
Okay.
Or identifying what is bad for you. It's easier to identify what can hurt you rather than what's good for you. So let's start with what options are not. I know some people use them as lottery tickets, but they really are not lottery tickets. Or you know, a safe haven, so to speak, because you can only lose what you paid for it. You know, you can't really blow your account. Oh yes, you can. You can blow your entire account with options if you're not careful. But there are also two main components of options that you need to be aware of. It's long volatility or short volatility. Okay. So essentially, when you're long volatility, you pay a debit. So you're essentially that's where the whole premium thing comes in. So you pay, say, $1,000 to take out to buy that specific options contract. It expires within 21 days. I'm just using a random example.
Yes. Okay. So
you can have different expiration dates. You can have daily. You can have weekly. You can have you can have 14-day one, 21 days, whatever. You know, there are so many different expirations.
What's the shortest one that you know of?
A 1-day expiration.
Okay. So it's essentially, so if I'm understanding you correctly, it's a bet, right? That so it's the same with any other trading. A long volatility would be at the end of that contract. It would be the price of the market would be higher, or the price of the instrument would be higher than that I bought it at.
Than that strike price. Yes. So exactly.
Okay, and that is called strike price.
Yeah, so the strike price is where you bought the option. So the strike, you get two types of strikes. You get ones that are in the money. So in other words, if you're to call option, which you want to go up in value, or a put option that you want to go down in value.
So call is up, right? Call is increasing. Yes.
Yeah.
And put is
down. Yeah.
Down.
So
that's a good one. Put, yes. Because
That's actually
sometimes
the
you
thing.
see on Fin
Yeah.
Twitter, people talking about call options and put options, and
Yeah.
everything can be a bit intimidating. But when you say it like that, it's easy.
This was actually the signal on the CME floor and all that. So call
Yeah.
or put. So
Okay.
these are the hand signals that they actually use. Not that I was
Okay.
there. I'm too young.
No,
for
no,
that.
but I mean, it's still interesting.
Essentially, so with the put option, obviously you want to go down, and a call you want to go up. So if you buy a strike at the money, so at the money you normally get what's known as a delta of 50. So a delta is just your rate of change. So if it's got a delta of 50, it means that for every point that it moves up, your option moves up half a point. And if it moves down half a point. So that's a delta. So delta is just the rate of change. Think of the triangle that we remember from algebra and all that. Yeah, but that's a long time ago. I'm not that.
Yeah, no, please don't get me into algebra. But anyway, I follow.
So it starts with that. That's known as one of the Greeks. So you get multiple Greeks. You get your first order Greeks, like your delta, which is your rate of change of the movement. You get your vega, which is your measure of volatility. So vega is essentially for every increase or decrease in implied volatility by 1%, your option will move up or down in value terms relative to that vega. And then you have theta, which is your time value decay. So if you are long volatility, in other words, you paid a premium, volatility time is not your friend.
Okay.
When you short volatility and you earn a premium, then time is your friend. So you're earning theta.
Okay.
So theta is actually, funny enough, one of the big things that causes people to lose out on options, because you can often find that you are correct in the direction that you picked.
But your time horizon is wrong.
Because every single day, that time value decay eats away at your option. Sorry, Rocco, I didn't want to interrupt you there, but
no. But you're right, because where I've seen that is trying to time a triangle triangle break, a flag break, whatever terminology you want to use it, because it's you sort of have to take it when it breaks, and trying to guess when it's going to break is very hard. You can be right, but your time horizon is wrong.
Yeah. No, totally, exactly. And what you might actually also find with options are actually not this surefire way to make money. There's a big misconception, especially in the retail world, that, oh, well, if I don't make it in futures, I'll just go for options. Boy, you don't know what you're letting yourself in for. Because the thing is, though, if you look at a future, futures are what's known as delta 1 or delta negative 1. So essentially means that if you're delta negative 1, in other words, if you're short, you want it to go down. So obviously, for every point that it drops, you make money, and for every point that it goes up, if you're positive delta, you make money. So it essentially means 1 for 1. That's essentially what delta 1 or delta negative 1 means. 1 for 1 with the market. When you trade options, you don't have that luxury of just that 1 for 1. Now you've got to figure out, where are my deltas located? Where is the strike that I bought? At what delta? What is the probability of hitting that delta? Statistically speaking, and I'm speaking under correction over here, that if you sell an option, let's say a put option, 1 standard deviation away from the market, so that's known as 1 sigma, your probability of profit, or POP, is 84%. But that is within a specific implied volatility and all that stuff. Now, if that implied volatility spikes, all of a sudden, you might easily find that your option could get hit. So if you're shortfall, you don't want that to happen. You want it to move. You want it to stay as far away from your strike as possible. Because unless so before I even go ahead, I forgot to mention that you also get different types of options. You get American options, you get European options, you get Bermudan and other exotics. But for simplicity's sake, let's focus on the European and the American options. So an American option can be exercised on any day during the duration of the option, provided that strike has been hit or exceeded. And European options can only be exercised on the last day of which is the expiration date. So even if it does move into that strike, let's say you've got a put option at 4,000 on the S&P 500,
Yes.
and that put option goes into the money, but on the last day it moves out of the money.
Then
you can't. Then
yes.
you've lost out.
Yes.
So yeah. So
but but I'm with you on the futures. But here's one thing that meaning that futures align more with my style and also like my preference. But here's the thing that I've learned is that just because something works for you doesn't mean that it's going to work for someone else. And that's, I think, the beauty of, if you delve into options and you find I'm better at this, right, than I am at futures, then by all means go for it.
Yeah.
But
I do agree with you.
But so that was my purpose of the conversation. It's like, yeah, it's maybe harder for us, but it could be easier for someone else. And leading into that, what are like two quote unquote easy options strategies for people to sort of go and look at?
Well, there are a few easier ones that you can look at. So if you want to say be pure long volatility, for example, you're happy paying premium, buy a call option or buy a put option. It can literally start as simply as that. So you can say you have a long bias. You buy a call option at X strikes. So remember, the more in the money you buy, or the closer at the money you buy, the higher the premium you pay, because of the probability of that strike being hit.
Yes.
Or getting in the money.
Yes.
And the further out you go, the less you pay. But the interesting thing about that, though, is market makers don't necessarily like these lottery ticket kind of options. They don't like making a market in it. So they actually charge you more of a premium for it than what you realize. So even in dollar terms, you might think you are paying less in absolute dollar terms. In terms of the probability of that getting hit and the liquidity that's available, you often find that you pay more, on a dollar cost basis.
Interesting.
So the same goes for put options too. So those are two of the easier ones that I would go for. Right?
Yes.
And obviously you've got to pick the time frame, and remember, the longer the time frame, the more you pay for it, because it has more time to actually go into the money. It's all about risk.
Yeah, and these strategies get extremely complex, right?
They can. So that is just literally basically entry level that I gave you over there.
Yeah.
But then you can also do, let's say you have a view that the market is going to break out in either direction.
Yes.
Like, for example, what we saw with the CPI.
Yes.
Then you can go and you can buy what's known as a strangle, which is essentially out of the money. Yeah, exactly. Out of the money, a long put and a long call. So let's say the market is trading at, I don't know, 4,200. Okay. So you go and buy a put option at 4,100, and you go buy a call option at 4,300. So they're both out of the money. Or you can have a narrower range.
Yes. Okay.
The narrower the range,
I follow you.
So the narrower the range, the higher the premium you pay, but the higher the likelihood of them getting hit. So that's why the higher the premium you'll pay.
Yes.
But that way, at least, if it gains on one leg, your other leg loses value, but not at the same rate at which the other one will gain. The only downside is you'll lose most of your money if the market stays within a flat range. So let's say it stays around 4,200, then you are up proverbial Schitt's Creek. But the flip side of that is a short strangle. So you are short volatility, but then then the view that you are taking is that the market is going to stay within that range. So you are earning. But if it breaks out of that range, then you start getting into a little bit of trouble. So then your probability of profits starts reducing, and the maximal profit that you would have earned also starts reducing. So
I know you are a man of research. So I want to ask you, before I let you go, some sources that you could recommend for the listeners if they want to go and read up and learn more about options, and like maybe you've tried futures and it's not for you, but there's still this avenue that you haven't tried. There's a lot of information out there. you go and look at Twitter and it's garbage. I go on Twitter not for the education, for the outlet, and just to take contra positions to whatever some of the fake gurus on there say.
The gurus,
Yeah, the gurus. So I'm like, from the horse's mouth, what sort of resources would you recommend?
Optionsplaybook.com is one of the best ones that I used to look at, because they actually use football style drawings and stuff to create these playbooks for you, which is really, really awesome. That's where I got my intro. But I also suggest watching other podcasts with guys such as Jim Carson or Noel Smith, Chris Sidiel. Chris Sidiel is a good mate of mine, and I mean I learned a lot. I learned a lot about options from talking to him. Another guy that I used to work with a lot was Jamie Glancy. So Jamie was the guy who introduced me to Chris, and he also taught me a lot about these strategies and how to look at different types of patterns and things, and how to understand the Greeks better, because it's a lot of stuff that you need to keep account of. That's the one thing that's one thing with options. Now you've got to take into account, how's my Vega doing relative to my Delta? How much theta do I have left? What's my Vanna, my Vama, my Zama? And it becomes very, very complex. So especially if you have a larger portfolio. So make sure that you are actually capable and willing to keep track of all these things. Otherwise, stick to futures. More often than not, they're actually cheaper to trade, and it's less complex. I prefer simplicity. That's just my that's just
me as well. But this made for a fascinating conversation, because I actually learned a lot this morning. And before I go and look at the things, we'll link everything at the bottom of the episode as well. Where can the listeners find you? What's the best place to connect with you, and what are some of the things that you're busy with at the moment?
Right. So you can connect with me on my Twitter at bhartspade. So that's where I'm active most of the time. You can also hit me up on LinkedIn if you want, but I'm more active on Twitter. Some of the things I'm busy with, I've enrolled for a BSc in business administration, so I'm starting that next month. I'm also looking at doing more public speaking gigs towards the end of the year. I think winter is a bit of a quieter time, though. People prefer to be at home as opposed to going out to venues and things. But leading up into the summer, we may see that. And just learning a lot more and trading more markets, man. I mean, this is a game where I never stop learning.
Absolutely. Adrian, thank you so much for joining me today. To our listeners, peace, love, and prosperity. I'll catch you in the next one.